Hello and welcome. Today we're going to break down a popular option strategy that sounds a lot more complicated than it really is, called the poor man's covered call, otherwise known as a synthetic covered call. Let's jump right in. Now, you've probably heard of a standard covered call. It's a classic income generating strategy where you buy at least 100 shares of stock and then you sell an option against it to collect the premium. It's a great way to earn some cash from stock that you already own. But here's the catch: you have to own those 100 shares. If you're looking at a stock like Apple or Microsoft, that could mean tying up tens of thousands of dollars in capital just for one position. For many investors, that's a huge barrier. This is where the poor man's covered call comes in. The technical term is called a long call diagonal strategy, but we'll keep it to synthetic or poor man's covered call. It's a strategy that's designed to mimic a covered call, but with a lot lower upfront investment. Instead of buying 100 shares of stock, you buy a substitute, a call option. It's a deep in the money call, and it's long dated. It's called a leap option, typically a year or longer. This gives you a bullish thesis on the stock for the stock to play out. A deep in the money means you would buy an option at a strike that is well below the current stock price. You want an option with a high delta, at least 80 or higher, typically like around the 85 to 90 mark. Just makes it a little bit more expensive, but it really tracks a lot closer to the stock. With a delta of 80, it means it's going to track like 80 shares of stock or $80 for that dollar move. That's why I like to go a little bit higher, go 85 to 90, because it tracks more closely with the actual stock. And it's a very effective substitute for owning shares. Once you own that long-term option, you can act just like a shareholder and you can start selling short-term calls against it. You would sell a call option much closer to the expiration date, let's say 30 to 45 days out, and a strike price that is above the current stock price. The premium you collect from selling that short-term call is your income. It lowers your cost basis on the long-term call that you bought, and you can repeat this process every single month. Let's take a look. To do a traditional covered call, you need to spend at least $21,000 in this case to buy 100 shares of Apple. It's currently selling for around 210. For a poor man's covered call or synthetic covered call, you would buy a leap instead that expires, say, more than a year out with a strike price that's deeper in the money. We'll look at that here in a second. You can buy that strike for around $6,700. That's a third of the cost than just owning the shares outright, and it will trade almost in parity with the same 100 shares of stock. So the benefit is better capital efficiency, and you only have $6,700 at risk. So if the stock were to completely tank, that's it. You're only going to lose $6,700, whereas the stock buyer could potentially lose a bigger chunk of his investment. The downside is you don't get to collect any dividend. On the stock holder, you get to collect a dividend. Now, in this case, Apple, they're only paying a 0.5% yield. It's not very much. It's probably not worth it for the typical retail investor. It's probably better to buy an option at $6,700 and then collect the premium from the sold short option. You do have another risk though with a option is time decay. Now, since we're buying with high delta, it really doesn't matter because it's already trading in parity, but there is a little bit of time decay with it. I do have some other videos on that you can watch. Okay, so now that we've talked a little bit about that, I think you can understand now that the benefits are clear. You get high capital efficiency. Traditional covered call, you need a lot more capital. A poor man's covered call will trade exactly the same, uses a little bit of leverage to your advantage, but it requires a whole lot less capital. Okay, let me illustrate what this looks like. Let's say this is the zero line here. As a typical stock buyer, that's your profit diagram. You buy here and you buy low, sell high, right? So that's a typical profit diagram. The way a covered call works is you're going to cap your profit because you're going to sell a short call here. And this is your income. This, let's say, is $600. I'll show you that here in a second. This would say be $600. So I get to keep that premium. That's the beauty of doing this strategy is I can hold 100 shares of stock for $21,000, collect that $600, or I can hold $6,700 worth of stock and still collect $600 by using two different derivatives. So that's the beauty. Let's go ahead and jump in and I will show you what it looks like on Thinkorswim and how to get this set up. Okay, here's Thinkorswim. A leap is something that is further dated like a year or more. So looking at these are my dates for my call options. I'm going to go out here to say September, 436 days out. So I'm over a year. Here's my delta that we were talking about earlier. I want a high delta because this would represent the number of shares that I'm holding. So this times 100. So if I were looking at Apple, I can go buy Apple for 210. That would cost me 21,000. Or I can go out here and let's say buy this one here. This is an 85 delta. So it's going to track like 85 shares of stock. I'll click on that. I'll buy that. Click here. And there it is, 6,700 bucks, 6,780 in this case. And you can see my profit diagram that I had drawn out earlier. Now, if you go back to this, look at my theta. Theta is my time decay. Because this is so far out, the time decay is very, very, very small. And it's going to lose maybe, if I were all things being equal, 436 days from now, the stock is still trading at $210. Well, I'm going to lose about 1,000 because I got 155 to 205 is 50 plus another 5, that's 55. Well, my option is trading for 6,700. So the time value of that is going to lose about $2 a day. But here's the kicker. If I'm selling calls against it and I go 37 days out, look at this, and I sell it at the money, here's 215. So I still got $5 worth of capital appreciation. So that's $500. I sell this one for, say, 580, 600 bucks. Well, now look, I bought it for 67. I'm making $600 worth of premium. Drop my cost basis down to 6,100. So I've nearly made 10% just in 1 month if I sell it here. Now, if it gets called away, no harm, no foul, meaning if the stock price goes above 210, I'm going to have to close my other position, my $6,700 position, because I'm going to have to be obligated to sell those shares. But that's okay. I made $500 on the upside because it went from 210 to 215. I made my $600 premium. So technically I made $1,100 for that position. That is the beauty of a poor man's covered call. So to sum it up, it's pretty powerful, capital efficient strategy for investors who are bullish on a stock long term and they want to generate some monthly income without buying the shares outright. It offers a fantastic return on capital, but it does come with its own set of risks. We talked about that a little bit ago. It's not for beginners. It's for those who understand options, and it can be a valuable tool in your toolbox. Always do your own research, understand the risk, and make sure that any strategy fits your financial goals. Thank you for watching. Happy trading, and hit the subscribe button. Thank you so much.